In this presentation, we will take a look at a balanced scorecard approach to measure performance. When we consider a balanced scorecard approach, what we're trying to do is measure the performance of different divisions within an organization. As we consider the measurement of how different organizations are doing, we typically think of financial goals, financial perspectives, putting together financial reports of some type, responsibility accounting reports that will then show the performance of each division. And that's going to be very important. That's going to be one of the fundamental factors of what we put together. However, we might want to put together other things that are going to be involved rather than just the financial perspectives, because the financial perspectives often don't take into account all the things that are necessary within a department. So to effectively measure the performance of the department, we might want to put together some type of balancing scorecard. In other words, we're going to put together some groups of things that we think are important for a particular department, including the financial perspectives of it, and then we'll somehow balance those items so that we can come out with a measure of how each department is doing based on those things. Notice that as we do this, although we're not talking about financial data all the way through, we want to make this thing as transparent as possible. We want to be able to say each department manager knows what they're going to be measured on. We want to make sure the measurement is as fair as we can, as transparent as we can, so that when they go and they actually perform, they know what they're going to be, what they're expected to do and what they're going to be measured on in terms of performance. One of the reasons that we measure based on the financial perspective so much is, of course, one, because revenue generation is going to be one of the major goals of the company. However, one reason revenue generation is such a major goal of the company, of companies in general, is because it is a really good indication typically of how companies do and how segments are doing within a company. Because obviously, if a company is doing well and they're regulating their costs well and they are generating revenue, those are good indicators that they are being run well and efficiently. So the financial perspective, the financial indicators that we use aren't just used simply because the revenue is the goal that we're shooting at. They also are very good indicators of the health of the company in many ways as well. But they're not the only indicators of the health of the company as well, and we want to take into consideration other indicators as well. As we consider the other big advantage note of the financial perspectives are that they're numeric. So that's the point of money in general, and us measuring things in terms of dollars. The dollars give us a measure of value, and that numeric value is really useful because we can obviously compare numbers to numbers, dollars to dollars. When we consider some of the other perspective, if we think of things like customer perspective and whatnot, a lot of times it gets a little bit more difficult for us to put a number to something as we can with financial perspectives. And that makes it more difficult to measure. Anything that is going to be subjective in terms of the measurement process is going to be different to measure across different people that have different opinions about different things, right? So as much as we can, even within these other areas, we're going to say, hey, I know this area is more subjective. I know that you can't break everything down to numbers, but as much as we can, we want to do that if it's applicable, if it's relevant to do so in a particular area. We want to do that. Why? Because that allows us to basically quantify this information. You could picture what's going to happen here. Basically, we have a vision that the company is going for. The ultimate vision that's going to be way out into the future is what we're shooting for. We typically have short-term goals in order to get to that vision, including the financial goals. One of the things we do not want to happen is that people take those short-term goals, like financial goals, and they sacrifice the long-term vision. For example, they sacrifice basically possibly the brand name or kind of the goodwill of the organization for short-term profits in order to meet short-term goals. That might help in the short term to meet certain goals, but it's going to be against the long-term vision. It's against what the shareholders typically would want, the owners of the organization, because they want the organization to be a long-term going concern typically. So sacrificing long-term going concern for short-term revenue at the expense of the name, of the goodwill of the organization or something like that would be something that would typically want to be avoided. One way you can try to look towards that long-term perspective is put together some type of balanced scorecard and say, hey, look, we're going to measure you based on this group of things that we think are more in alignment with the long-term perspective. Yes, the financial goals are included, but we have these other things involved as well. We'll obviously to make this transparent, need to put some type of weighting on these different categories as well, so that people know exactly what they're going to be measured on, what the weight is between these different categories. These things will change, of course, from company to company, as company to company have different visions, different long-term visions, how they want to measure those long-term visions, what emphasis they want to put, what's more important based on different type of industries, where should their emphasis be put in different types of industries. It will change based on the industry that we are in. So this is just kind of some general categories that would be put in place to emphasize the fact that we need more items involved within the measuring process, especially for larger organizations. Many of this will change from company to company, but also there's a lot of standards at this point that are working from company to company. So although it's managerial accounting, it will change from company to company. We can also see what other companies are doing and say, how did they do that? How did they quantify that? And see if it's applicable to the company we're in as well. So here's some categories we could have. We can have the customer perspective, of course. We can measure things within the customer perspective. The internal processes, how are the internal processes doing? Measure those, the efficiency of those, the financial perspective, and the innovation and learning type of perspectives. Within these items, we might then put together some type of measurements that we could use in order to judge these different areas. And again, we want to quantify these measurements as much as possible to be as transparent as possible. For example, customer perspective, we might have customer satisfaction ratings. Now you might say customer satisfaction surveys. We probably have those too, and we'll get a lot of feedback in terms of text. We'll read through all that and see if there's anything that we can apply to it. But note that if we get the rating, that's going to be a way to quantify it. And that's going to be a lot easier for us to say, hey, this is how this department is doing based on customer satisfaction ratings as compared to some other company or department. And we can make that comparison a lot easier. Now, if there's stuff that's coming up in the text in surveys, then of course we might put that in a numerical format. We might say, hey, is this something that you would want? Say how much benefit this would be to you in a 1 to 10 kind of analysis. And that way we can try to, again, quantify it in some way, which is a little bit easier for us to do comparisons with if it's applicable. Number of new customers acquired. Again, we're trying to quantify it in some way. How many new customers do we have in this department compared to another? Percent of time deliveries, percent of on-time deliveries. And notice we have to use a percent here because, again, some departments might be bigger or smaller than another department. So we can't just use total on-time deliveries versus non-on-time delivery, right? We have to use some type of percent in case the departments aren't equal in size. Percent of sales from new producers, same kind of concept. They might not be equal in size, so we would use the percentage. Time to fill orders, we can take this good old stopwatch and to say how long it takes to fill, or track in some format how long does it take to fill an order. Percent of sales returned. Again, we can think about how many sales are returned, and that would be an indication from the customer of how satisfied they are. Internal processes. So we're measuring the internal processes. We could have the defect rates. How often is there defectiveness in a certain department? And again, we can compare from department to department using a rate. We can have the cycle time. How long does it take to go through the processing cycle? We can have the product costs, of course, measuring the product costs, labor hours per order. How long does it take? We can, again, pull out the stopwatch and think about how long does it take per order to go through this process, and then refine down the processes. Note, again, everything is being broken down in numbers as much as possible so that we can basically do the comparison. Production days without an accident. So how long has it been without an accident? And then, of course, the financial perspective. We have obviously the financial data, the net income, the things that we're most focused on. And then we have our ratios, the ROI, return on investment. We have the sales growth. We can measure sales growth, cash flows. These are all things that obviously we have the financial data and we can see numerically. We have the residual income, the stock price. These are all financial indicators that we can be using. And then innovation or learning. So we want to think about the innovation and learning. And again, some categories that we could come up with in there would be employee satisfaction. So we can try to measure employee satisfaction in some way. Again, possibly numerically. We'll probably put together some numerical thing. How satisfied are you on a 1 to 5, 1 to 10 scale, and this, that, and the other type of category. Employee turnover. Measuring the employee turnover, how many employees are leaving, how often do they leave, We can look at those rates to do that, quantifying it. Dollars spent on training. How long does it take to train? What is the training costs? Are we spending time to make people happy within the training? What's the training look like? Number of new products. So we can take a look at the new products that are out there as an indication of innovation. Number of patents. Dollars spent on research.